All right, so this is our final lecture here to prep for our NOCTI exam that we're going to take next week. Just to recap a little bit about the things that we've talked about so far. We talked about accounting principles and ethics. Primarily, we focused on confidentiality, integrity, and conflicts of interest, right? Confidentiality being that we keep private information private. Conflict of interest being that we avoid situations that are or could appear to be a conflict of interest between our personal interest and our business duties. I said duties. You laughed last time I said I don't know. Okay. And then integrity, right? And that's just doing the right thing even when nobody's watching. And doing the right thing even if it comes at a personal cost to us. All right. And so if we know that we're potentially entering into something that could appear to be a conflict of interest, we're a person of integrity, even if nobody would ever know, we remove ourselves from that situation to maintain the accounting principle and ethic, which is the higher calling to the industry, more so than what our code of ethics maybe within our business or employee manual might say about how we act and do business. All right, then we talked about the accounting process. We discussed the accounting life cycle. We talked about the 8 steps, but some texts might have more than 8 steps. Some texts might have less than 8 steps. And so we talked about sole proprietorship primarily. I'll give you a handout that walks through the same kind of accounting cycle for a corporation. We talked about financial statements. We talked about the income statement, the balance sheet, the statement of stockholders' equity or retained earnings, and the statement of cash flows. And so if you remember, the statement of cash flows had 3 main parts, and we wanted to make sure that we understood what activities of the business fell into those 3 categories. Remember, the statement of cash flows is also the only statement that uses the cash basis of accounting. Otherwise, we normally use the accrual basis of accounting, which follows GAAP. GAAP, which stands for Generally Accepted Accounting Principles. And then we zoomed in on closing journal entries, right? And we talked about Reed. Remember, Reed's going to be handling our closing entries there. Well, first, you got to close revenue, and then you got to close expenses. You want to close the income summary account. Then you want to close dividends or drawing. And so that's how we came up with that acronym. And Reed's going to handle that for us. So keep that in mind, closing entries. Today's focus, we're going to talk about financial ratios and payroll. So a lot of those vertical analysis, horizontal analysis that we performed in class while we were creating or got to the point of creating our financial statements, we're going to just review those today and talk about those a little bit. All right, so remember that financial accounting primarily provides information for external users to evaluate the health of a company. Managerial accounting, on the other hand, which we didn't really get into in this class, but if you take accounting 2, we will get into managerial accounting on the second half of that accounting 2 class. Managerial accounting, on the other hand, serves for internal users, and it helps managers and employees make decisions. And so before external users see financial statements, businesses can analyze their own financial health by looking at financial ratio analysis, right? And so vertical analysis or horizontal analysis is what you guys looked at when we were creating financial statements during the class. And so the key categories for ratio analysis is going to be profitability. All right, so that's one of the things that you want to look at is the company's profitability. And profitability is simply how well are we earning how well are we making money? How well are we earning profits? We also wanted to look at liquidity. And liquidity is our ability to pay our short-term debts. Our ability to pay our short-term debts. And so remember, liquid assets are those that are cash or quickly converted to cash, right? And so when we talk about the quick ratio, we were just looking at cash and cash equivalents or things that could quickly be turned to cash, maybe accounts receivable. All right, and then we have solvency. And solvency is our ability to pay our long-term debt, all right? So liquidity is our ability to pay our short-term debt. Solvency is our ability to pay our long-term debts. And then finally, we would look at market performance. And so how are we doing in comparison to ourselves from prior years or in comparison to other competitors in the industry? So market performance, how is our stock performing? What does our stock price look like? How's it performing? All right, so first, profitability ratios, primarily the gross profit margin or gross margin. All right, and so gross profit margin, sometimes maybe just called gross margin. And our gross margin is our gross profit divided by net sales. And gross profit, remember, is our net sales minus our cost of goods sold. All right, and then we have, all right, so that's the main profitability ratio that we talked about. What does this tell us? This tells us how well the company sells products above their cost. How well we sell products above our cost. And remember, it does not account for operating expenses. So our day-to-day expenses, keeping the lights on, paying our employees, remember the gross profit margin does not account for that. All it's looking at is what kind of margins are we making on our sales. So what did it cost us to buy or produce whatever it is, and how much are we selling for? What's the margin on that? That's what the gross profit margin and the gross margin is looking at. All right, and then you have your operating margin, and your operating margin accounts for those operating expenses like utilities or salaries or rent, right? And so the operating margin is also a profitability margin, but the operating margin it accounts for operating expenses. So it's going to take our operating income and divide it by net sales, and that would be our operating margin. Remember, your operating income is your gross profit minus your operating expenses. All right, so your operating income is your gross profit minus your operating expenses. So if you think about the income statement, right, it starts out with sales, and then you take away the contra accounts to sales, and you get your net sales, right? And then you take your net sales minus your cost of goods sold, and the cost of goods sold, that's a whole other section, right? You're looking at beginning inventory plus purchases, or net purchases equals your cost of goods available for sale minus your ending inventory equals your cost of goods sold, right? So then you take your net sales minus your cost of goods sold, that gives you your gross profit, and then you list out all your operating expenses. And then you take your gross profit minus your operating expenses, and that gives you your operating income. And then we, took away income tax, and then we had our net income before and after federal income tax, right? And so this is primarily, if you think about this, this is our vertical analysis on our income statement. Is our gross profit margin, our gross margin, and our operating margin. All right, so when you're trying to figure out how you're doing, what you're going to do is compare yourself to some sort of benchmark, all right? And so benchmarking is comparing your ratios against industry standards. So maybe you look at your competitors and you get some sort of standard from your competitors, like your gross margin, maybe it's 40%, all right? What is the industry standard? If the industry standard is 50%, then that means that you're selling likely at a lower price than your competitors are, and maybe that's a good thing. Maybe that's your strategic move of undercutting your competitors, right? Or maybe that means that you're paying too much for your cost, and you need to lower your cost of producing or purchasing your inventory. And so you got to figure that out, right? You can get closer to the industry standard, or you could just compare it against your own company's historical standards or data. Is your gross margin staying relatively the same from year to year, or is it rising and falling? And if it is, then what's going on? Or is your price increasing? If your price is increasing because of tariffs or something like that, are you increasing your prices that you're selling to consumers for? If you're not, then maybe you need to make that change in order to make sure your margins stay where they ought to be or where you want them to be. And if you're a new company, then you just have to go off your projections. You benchmark it against what you projected to be making at that time period of your business. All right, so that's benchmarking, comparing it to industry standards, comparing it to your historical data, or comparing it to your forecasting or what you thought it should be. And then if it's not meeting those, then what do you need to change, or what do you need to do differently to get it to where you want to be? Don't wait for it to fix itself, right? If your margins aren't where you think they should be, take action, do something about it. Either find vendors that'll sell you stuff at a lower cost, or raise your prices. I mean, those are primarily the two things that you're able to do to change your gross margin. You can either find cheaper vendors, or you can raise the price to your consumers. That's how you're going to manipulate your gross margin, right? All right, so another thing that you might do in addition to benchmarking is trend analysis. And trend analysis is using data over several periods of time to help you plan for the future, right? So if you have fluctuations in your sales, if spring is really heavy for sales for you and wintertime is really low for sales for you, then if you have historical data or you see the trends, then you can plan to make decisions based on those trends. You want to purchase more inventory in the spring, purchase less inventory in the fall, right? And so make those adjustments based on trend analysis. You could also, change your staffing. If you're a Callaway's nursery, when do you probably need more employees on the floor? In the springtime, when people are planting. When you need less people on the floor? Probably during the fall and winter time, when fewer people are planting or visiting their local nursery, right? And so you can make those changes based on trend analysis as well. All right, the next thing is market ratios, and these are primarily for corporations. And so market ratios or market performance, you look at earnings per share. Okay, so you could look at your earnings per share, which is your EPS. And your earnings per share is your net income divided by the number of shares outstanding. And so you would get your net income from your income statement. You could get the number of shares outstanding from your statement of stockholders' equity. Or that detail might be on your balance sheet, but more than likely that detailed information that you need for number of shares outstanding, you'll be able to find on your statement of stockholders' equity. You can't compare EPS across companies directly. It won't work. You can't compare EPS for ExxonMobil to EPS for Costco gas. It's not apples to apples because the number of shares outstanding is going to change that. So if you try to compare them, it won't work. You have to manipulate those EPS numbers a little bit so that you are comparing apples to apples, because the number of shares outstanding is going to be different for each company. All right, another thing that you can look at is dividend yield. I before E except after C, but what about after a Y? Dividend yield. All right, and your dividend yield is how much dividends a company pays relative to its stock. And so growth companies like tech startups usually have low or no dividends because they're reinvesting their earnings. Income stocks from like large and stable companies typically have higher dividend yields. All right, so dividend yield is going to be higher for large companies, large stable companies, because they're going to be sharing the wealth with their stockholders more often and more frequently, whereas tech startups or smaller companies are not going to be sharing the wealth. They're going to be reinvesting the wealth into the company to help it to grow. All right, so this is like dividend yields are typically going to be lower for growing companies, growing or young companies. And then the price earnings ratio, or the PE ratio. Your price earnings ratio equals your market price per share divided by your EPS. So whatever your market price is per share, divided by your earnings per share. And that is your price earnings ratio. And so growth stocks tend to have a high price earnings ratio, where income stocks have a lower price earning ratio. So these are income stocks, and your tech startups would be considered like growth stocks. All right, liquidity ratios. So jumping back up here, liquidity ratios, your ability to pay your debts. You have your current ratio. So liquidity, you have your current ratio, which equals your current assets divided by your current liabilities. This includes inventory, which can skew the ratio if you have like an excess of unsold goods. So your current ratio is your current assets divided by your current liabilities. And then another liquidity ratio would be your quick ratio. And your quick ratio is going to look at your most liquid assets. So you're not going to include your inventory in it. So typically it's just going to be your cash and your accounts receivable. But you could also think of it as current assets minus inventory. All right, so just your most liquid assets divided by your current liabilities is going to be your quick ratio. And so this is a more conservative look at your liquidity, or your ability to pay your short-term debts, is the quick ratio, because it focuses on cash and assets that are easily convertible to cash. All right, if these ratios fall below what your benchmarks are, that indicates that you have liquidity problems. That's not a good sign. And so even if you are a growth company, you want to have cash on hand to pay your short-term debts. And so if your ratios, whether it's your current or your quick ratio, falls below what your benchmarks are for your industry or for yourself based on historical data or what you projected it to be, then that indicates potential liquidity problems. All right, and so the last thing I want to talk about is payroll basics. There's just a couple of things about payroll that I want you to be aware of. One is gross payroll. Gross payroll is basically your employees' earnings before anything's taken out. All right, so it's the total earnings of your employees. Your gross payroll is your total earnings before anything is taken out. So this is essentially, if all of your employees are hourly employees, it's the number of hours they work times how much they get paid per hour. It's your total earnings. Before anything is taken out of it, it's your salary, or if it's hours worked times the total number of hours, the amount that they get paid. Your net payroll is your total earnings minus all of the deductions. All right, and so remember, you have some mandatory deductions. Everybody's got to pay into Social Security and Medicare. Then you got some elective deductions, right? If you elect to have health insurance, if you elect to contribute to your 401k, and so on. And so your net payroll is the amount that actually employees take home. That's their take-home pay, what actually gets transferred into their account after all the deductions are taken out. All right, so you have your mandatory payroll deductions, which is your Social Security, Medicare, federal, state taxes. And then you have your voluntary deductions, which is your health insurance premiums, retirement contributions, all right? And so your net payroll is your gross payroll minus your deductions, right? So your net payroll is your gross payroll minus your deductions. So just quick takeaways: financial ratios give insights into profitability, liquidity, solvency, and market performance. Always compare those ratios to benchmarks and analyze trends over time. If the ratios are off, investigate, see what changes can be made to get your ratios where they should be. So take corrective action. The answer for this is never wait and see. The answer is, hey, we got to do something, okay? There's some things that are unpredictable that could happen. Nothing we can do about it, but we can plan for the unpredictable, right? So if you are coming up on a presidential election and there's two candidates and one of the candidates is like tariffs, 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 and the other candidate is not, then if you're a big company and you know that this is down the pipeline 2 years in advance, you're going to start to plan for those tariffs. You need to start to plan to set aside some monies to make sure that you don't have to announce huge layoffs because now you're having to pay tariffs, right? So you can plan ahead. There's some things that you can't do or can't control, right? As much as you pay. This is getting way off of NOCTI now. I just need to cut the recording. All right, so take corrective action. Plan for the future. Plan for the unexpected. That could be political. That could be the weather. Plan for the weather, Like, is there going to be a major hurricane? How can you plan for that? If 1 year the crops are completely decimated because of a tornado or something, how can you plan in advance for that? All right, so then payroll was the final thing we talked about, and it involves gross earnings versus net pay after deductions. And I think those 3 lectures should put you in good shape for the NOCTI test. So I expect to get like massive amounts of views on my YouTube channel, so I could turn it in.